Hey guys, how's it going? It's Andy from Magoo Investing. Happy Wednesday. Kind of forgot what day of the week it was considering we did have a market holiday on Monday. In today's video, I want to talk about this article that popped up on my feed from the Motley Fool, talking about 4 reasons why they think the stock market might crash relatively soon. If this video title seems kind of familiar, it's because it is. This has been a topic that's been talked about on the Motley Fool, specifically from this author for the past 4 months at this point. So it doesn't mean that it's going to happen anytime soon. Probably not, but I always think it's a good idea to go back and look at some of the potential catalysts that you identify to start a potential stock market crash, because everything's going to be going great until it isn't. Then some of the things that have been propping up the stock market are going to go away, and we are going to see a major correction. It's not if it's going to happen, it's going to be when it happens. And am I saying it's going to be anytime soon? No. But I did want to give my explanation for 4 reasons why this author thinks that the stock market could crash relatively soon. And let's talk about some of the things I'm seeing with the overall stock market, considering we are at all-time highs. I think we've hit 7 all-time highs already in 2021. And as of right now, I don't see that stopping anytime soon. The first thing that the author mentions in this article talks about valuation. Valuation for the stock market has been messed up for a long time. It's hard to look at the stock market and argue that things are not overvalued at this point. With the pandemic, there's been more of a focus on companies treading water instead of focusing on future growth. For example, Apple stock has been up 80% in the past year, which is fantastic. Everyone makes money when the stock market's up. The problem is when you look at it, their earnings per share was only up 3% and their revenue was only up 2.5%. So usually when you look at a stock, the reason the stock goes up because the outlook of the company is better than what we've had in the past. And we haven't really seen that with the stock market so far in 2020 going into 2021. The expectations have changed, and that's resulted in these ridiculous valuations for these companies that have not seen increases in the growth metrics that we see with revenue, earnings per share, net income. So things have not gotten better for these companies, but we have had the valuations go up. This article talks about the Shiller S&P 500 PE ratio being at 35.6, and this is a very inflated number. It's at the highest it's been since the dot-com bubble, and anytime you're comparing to one of the largest bubble burstings in stock market history, it's usually good to kind of pay attention to why things like this are happening. As I mentioned, the pandemic is the main reason for that, because earnings have not been going up, but the price has been expanding rapidly. The current number that it's at right now of 35.6 is double what the average has been for the past 150 years. So yes, the stock market is very inflated when you look at it at a valuation standpoint. But I've talked about on this channel that I don't look at PE ratio as being this end-all be-all determinant of how valuable or if you're getting a good deal with a company, because as of right now, the stock market is all about comparing to the expectations. And I think that's, it's interesting. But when you look at how the Shiller PE ratio has reacted in the past 4 times it's happened, if something happens once, you can call it an anomaly. If it's 2 times, you can connect a trend line and you can make it a trend. But the 4 times that the PE ratio for the Shiller's PE ratio has been above 30, the S&P 500 has fallen between 20 and 89%. Am I saying this is going to happen? No. One of the reasons why I think we might not see a correction like this is one of these words that I swear if you looked up the search results for this term, it's going to be a ridiculous number, and that's unprecedented. So considering this is not something that we've seen before with a global pandemic affecting the stock market this much, it's going to be hard to tell if the stock market is going to react in the same way that it has the previous 4 times of being this inflated. So while I don't see PE ratio as being a huge red flag, it's very interesting to see what investors are looking at to judge the value of a company, because in the past, you have always been looking forward for a valuation, the guidance. And with the pandemic happening, we haven't been looking forward. You've kind of been comparing to what stocks have done year over year and kind of comparing to what it's done in the quarters during the pandemic. So that's the first thing that they mentioned in this article. Number 2 has to do with the emotions after the GameStop fiasco. If you've been on this channel for the past couple weeks, I've talked a lot about emotions, because emotions are one of the hardest things to teach when it comes to the overall stock market. You can learn all you can about when you should be entering, when you should be exiting, stocks to find. The hardest part about investing in the stock market has to do with selling. I've talked about this in a video recently. The 2 hardest things in the stock market is 1, selling when you're winning, because you usually have something like greed taking over. But the hardest thing is selling when you're down. And with the GameStop fiasco, we have a lot of new investors that have seen how quickly emotions can change with the overall stock market. You had GameStop as being the most popular stock to talk about on places like Twitter. Now we don't see that much of a talk anymore, and it's mainly stuck on places like Wall Street Bets that are people that are still holding at this point. So if we do see a move to the downside, I think it's very likely that we will see retail investors selling. But as I mentioned, retail traders are the most important that they've ever been. There was a point this past summer where I think 25% of all trading volume was done by retail traders, which is a crazy high number. And yes, at one point, 50% of all Robinhood accounts did own some shares of GameStop, and that does result in a lot of movement when it comes to something like a GameStop, deciding which direction that's going to go. But when you look at the overall market, the average Robinhood account is $2,000. That is nowhere near what people are moving with the institutional traders, hedge funds, stuff like that. So yes, emotions after the GameStop fiasco are running high right now, but we have some of the emotions that it's kind of this narrative that the GameStop situation was all about these retail investors going against these hedge funds. In reality, I talked about why I was expecting that we're going to see a lot of hedge funds coming out and saying that they made a lot of money. They usually try to go all in to try to burn the other hedge funds that are maybe a little too risky when it comes to the overall market. So panic selling from new investors will not be that big of a trend, but it is something to watch at all times. Number 3, the author mentions the pandemic. Obviously, the pandemic is what caused the stock market crash at the beginning of 2020. But I've been trying to think about ways to kind of compare what the market crash feels like from March of 2020 compared to what we have now. And as of right now, I don't think the pandemic's that big of a deal to the overall stock market. And that seems crazy to say because of how much people's lives have been impacted by the overall pandemic. But the pandemic was a huge catalyst. We had no idea what was going on. And I think it's very similar to when you think about IV crush when it comes to selling or buying options around an earnings report. The IV crush happens when you have uncertainty before a major event. It could be a news story, it could be an earnings report, it could be a merger. Before the news gets released, you have all the uncertainty of what's going to happen. Is it going to go up? Is it going to go down? And that's the reason why these options have so much value before the report comes out. Then the report comes out, you have a better understanding of what's going on, and the value doesn't matter as much. And the stock market kind of forgets what was going on with that stock. And I feel like that's what's happening when we talk about the overall pandemic. The last big news referring to the pandemic happened when the vaccine was first announced as being ready to go out to people in early November. And as a result, the stock market shot up 3%. And if you were around during the previous summer, pretty much every day was talked about, do we have vaccine news coming? Yes. Fantastic. Market goes up. Has it been delayed or did not go well? Stock market goes down. But now that we've gotten to the point where the market doesn't really care about the overall pandemic, this article talks about what if we have this new variant that comes out and it's worse than the previous one? What if we have poor rollout? Well, we've already seen poor rollout and the stock market's up significantly already in 2021. So as crazy as it sounds like, I don't think the pandemic is going to play a big factor if the stock market crashes, because at this point, the market is pretty used to how things are going, the expectations of the overall market, and especially the analysts' expectations when it comes to earnings. But I think the most interesting thing to talk about has to do with stock buybacks, which is the fourth thing that the author mentions for a potential catalyst to start the stock market crash. I've made a couple of videos in the past year being very critical about companies and how they've decided to spend their free cash flow. And one of the places that companies are allowed to put their free cash flow has to do with stock buybacks. And you do have some very bad instances of companies, especially the airlines, spending 96% of their free cash flow on stock buybacks in the past 5 years. Why was this a problem? For one, it increases their debt as they use their assets to buy back their share price, but doesn't actually boost the company in any way. It boosts the share price, but it doesn't affect the product that they're putting out. Number two, with the pandemic, companies like the airlines needed aid because they didn't have enough money to pay their employees through this tough time, and that's when they needed the bailouts. And number three is you have the incentives for executives to boost the stock price, because if you're an executive and you can make $1 million payout if the stock price stays above a certain level, yes, there's going to be incentives for buying back stocks. It does not help the overall sense of the company, and we saw that with the airlines where they spent 96% of their free cash flow on stock buybacks. They needed aid to get a bailout from the government, and the second that the lockup for what they were required to do during that the agreement to the bailout, they started laying off people. And we saw 90,000 jobs from airlines get cut because these airlines didn't have enough money. But they did have enough money if they didn't use it on the stock buybacks. It's going to lead to a video. I'm going to make all about this topic this weekend, talking about probably the biggest myth of the overall stock market. It's something that I always seen talked about as the reason why stock buybacks are such a beneficial thing and why they need to happen. But no, they don't. Stock buybacks have surged in the past year. Part of it comes from the reduction of the corporate tax rate under the Trump administration. The idea that Trump said was that it's going to put more money into the corporation's hands, which is in turn going to trickle down to the average family. The numbers that the Trump administration released expected that around $4,000 per household was going to be given as a result of this tax cut. The problem is that trickle-down economics don't work, and we know that for a fact now. And the numbers that I could find, where do the benefits of the tax cuts go? It's not a shocker that it goes to the top 20%, and it's not even slightly a shocker to see that a lot of it goes to the 1%, and the bottom 20% of Americans, the bottom 40%, does not get as much. Trickle-down economics doesn't work. At this point, there's been some talks that Biden is going to raise the corporate tax rate from 21% to 28%. Is that a boost? Yeah. But considering that it was at 35% under the Obama administration, and when I put up the chart of the corporate tax rate over the past 50 years, it is incredibly low, and it's been going down since 1980. That's resulted in great gains for the overall stock market, which is fantastic for investors like you and me. These numbers are going to need to change at some point, because The things that you can do with free cash flow: you can do stock buybacks, you can pay out a dividend, you can hold on to it in cash, or you can invest into yourself with research and development, also called R&D. The problem was, in 2018, the year that the corporate tax cuts started, it was 2017, but we really didn't see the impact of it until 2018. During that year, only 43% of the S&P 500 companies had any type of research and development expense. So only 43% are spending their free cash flow on innovation. And that was kind of the whole idea of the corporate tax cut, was that they're going to be spending more on innovation, they're going to be helping their business. To make that number look even worse, 38 out of the 500 companies makes up 75% of all the R&D spending in 2018. In comparison, more than 80% of all the free cash flow went to investors during that year. Is that a good thing for investors like you and me? Sure. But are we seeing the innovation? Are we seeing these companies come out with better products, better earnings, and moving into bigger markets? No, we haven't. And so that's been great for people that are involved in the stock market, but it's kind of increased the distribution of wealth that we've been seeing in America for so long, because the people that are involved in the stock market make a lot of money. And the whole reason for me making this channel is I wanted the lower people in the income bracket, myself included, to get involved with the overall stock market. That's why we've seen this huge spread of the people that have been able to take advantage from these tax cuts. And the US is deeper in debt than it's ever been. Stock buybacks are going down in 2020, but I expect to see that bounce back in 2021, when kind of the magnifying glass is pulled away from some of these companies that were holding on to cash because either they got a bailout from the federal government, or for the bank situation, they aren't allowed to do stock buybacks until a certain point because of the safety measures that were put in place as a result of the financial crisis back in the late 2000s. So will any of these 4 reasons be the reason why the stock market crashes on its own? No, most likely not. It's going to take a lot more to happen. We've seen the resilience of the overall stock market, and we've seen that the stock market does not represent how the overall economy is doing. And I think that's something that a lot of people need to understand. Am I protecting myself by having a lot of my portfolio sitting in cash? Yes. Is it likely that the stock market is going to continue to go up and I'm going to lose out on some pretty good gains as a result of that? Yes. I do think the stock market has to crash. It's not a question of is the stock market's going to crash, it's when the stock market's going to crash. So right now I'm protecting myself. Let me know what you think is going to be needed to make the stock market crash in the comment section down below. Thanks for watching. I appreciate all the support, and I will see you in the next video.